Hi, everybody, and thank you so much for joining us for this Network in Action special webinar. Network in Action is a business services organization, and we work with small businesses to help to connect them with other small business owners. And during this global crisis, this global pandemic, we were hoping to provide you with some additional information. And so I have gathered here with us a panel of experts to provide small business owners with some really important information regarding your financials. With this pandemic going on, how do you account for unexpected expenses that you've had as a result of this disaster? How do you account for grants that you've received or loans you've received that you usually don't have to account for in your accounting, in your books? So I'm really thrilled to invite our panel of experts here. And we're going to start today with Lorena Armstrong. And Lorena is with my staff, your staff. So Lorena, thank you for joining us. I'm going to turn this over to you.
Thank you so much for having us today, Christina. I'm going to go ahead and share this presentation with you. Today I'm going to be talking about the PPP, the Payroll Protection Program, which was created by the CARES Act, passed on March 27th in response to the emergency declaration issued for the nationwide shutdown to slow the spread of the COVID-19 pandemic. This program offered employers a forgivable loan equal to 2.5 months worth of payroll, which was meant to cover 8 weeks of payroll along with rent and utilities. The intention was to keep people on the payroll with their employers, even if they were unable to actually be open for business and working, rather than these folks being technically unemployed. The program basically bypassed the temporary unemployment process by giving employers the funds to administer benefits directly to their employees. This program created the ability to press pause on your business for a couple weeks without experiencing the kind of financial ruin that would ordinarily come from several weeks of no incoming revenue. The program was very popular with business owners who were scrambling for resources and a plan to stay afloat, but the program was not without flaws. Politicians, not being bankers or accountants or business owners, were extremely unaware of the difficulties that would come along with distributing these funds and then utilizing and accounting for these funds, caused quite a shakeup in the business and accounting community, and has led to several rounds of rule revisions and clarifications. So to avoid further complicating anything, we're only going to be discussing the most recent and current guidelines, which may be a little different than what you might have heard before. There we go. Incurred versus paid. There's some technical language in the PPP program that created some confusion about the timing of which expenses you can include in your PPP. So let's talk about what these words mean. Incurred means obligated. An expense is considered incurred when you become obligated to pay it. For example, your employee Sally worked yesterday, Monday, the 5th of October. So yesterday, you became obligated to pay her for that time. Yesterday, you incurred Sally's payroll for the day. Paid is satisfied. So for example, because your work week runs Monday through Sunday and you pay your employees the following Friday, that means you will have paid that expense when you hand Sally her paycheck on Friday the 16th to pay her for the work that she did on Monday the 5th. This was actually a really important distinction because it meant that I can squeeze more than just 8 weeks of hours worked into my 8-week PPP period. And I'll share some more about that when we talk about timelines. Covered periods. How long do I have to spend my PPP money? The current guidelines state that you have a minimum of 8 weeks up to a maximum of 24 weeks to spend the money, or until December 31st, 2020, whichever happens first. Why would you choose 8 weeks? Well, you might choose a shorter period so that you don't have to worry about your full-time head count anymore. And you might choose a longer period so that you would have more time to use all of your money. With a longer period, it would be possible to even spend all of your money on just payroll, which is a whole lot easier to prove for your forgiveness application. You would have a lot longer to figure out how to account for your money and your expenses, and you'll have longer to get your full-time head count back up if those are currently down. So lots of people ask if you have to go the full 24 weeks. You do not. You can participate for as little as 8 weeks up to a maximum of 24 weeks or the December 31st end date. If all your money is spent after 10 weeks, then you could be done at 10 weeks. So an example of how I would calculate what my PPP timelines are. All right. I was one of the first ones in line, so I got a PPP loan that funded on Wednesday, the 15th of April, 2020. My options for my covered period are that I can start it on April 15th, which is the date that my loan funded, or I can start it on April 20th, which is the date that my next pay period starts. If I want to go with the 8-week period, that would mean that I'm going April 15th through June 9th. I can include checks that I give to my employees on Friday, the 17th of April for work that they did April 6th through 12th. I can also include the hours that my employees are working on Monday, June 8th and Tuesday, June 9th, which I will pay the normal pay date of 6/19. I can include bills that I've incurred that are allowed expenses from April 15th through June 9th. If I was going for the longer 24-week period, that would be April 15th through September 29th. I could include paychecks, again, still from that Friday onward. I can include hours worked on Monday, September 28th and Tuesday, September 29th. And I can include bills that were incurred April 15th through September 29th. There's an alternate period. If I wanted to make it a little easier by starting my covered period when my payroll period starts, I could start it on April 20th. And if I was going with the 8-week timeline, that would mean April 20th through June 14th. I could include paychecks on Friday, the 24th of April for work that was completed the week of April 13th through April 19th, even though that was partly before my PPP loan started. And I can include hours worked that last week of my PPP, June 8th through June 14th. But I will note that there was some language in there that specified that you could include that last week of pay incurred if it's paid out before the next regular payroll date. We don't really know how strict they're going to be with that, so might be a good idea to just go ahead and issue those last paychecks a day early to be on the safe side. If I'm going for the 24-week period, that would be April 20th through October 4th. I could include my first paychecks that I issue on the 24th. I can include that last week of pay that I'm incurring for work done September 28th through October 4th. Again, might want to look at paying a day early just to be sure. Something important to note if you're going to use this alternative covered period is that your bills, like your rent bills, utility bills, things like that, don't go on the alternative period. They are still on your original covered period. So that would be the one that started April 15th. Also important to note, it can be a little confusing for some people who got their money at different times. When is the actual end date, right? So if you got your money before the middle of July, your 24-week maximum will actually end before the end of the year. If you got your money in late July, your 24-week maximum is not actually going to be 24 weeks. For example, if you were one of the last people to apply in August and you funded your loan in mid-August, your PP period would really only be a maximum of 18 weeks because it ends December 31st, 2020. Hard stop for everybody. That's the end date for all of us. Let's talk about head counts. Part of the stipulation of the PPP program was that businesses needed to keep their employees on the payroll and at a similar rate of pay. The rules included full-time equivalent FTE headcount calculations as part of your forgiveness calculation. An FTE is a full-time employee who works 40 or more hours per week. For part-time employees who work less than 40 hours a week, there are two options that you can go with. So for example, let's say you have a part-timer who worked 15 hours last week. You could calculate them out. They would be 0.38 full-time equivalent. And this week they worked 30 hours. So you would calculate that out, 0.75 full-time equivalent. To avoid having to do all these calculations and dramatic changes, fluctuations to your full-time equivalency every week, you do have an option to do a simplified calculation, which is just assigning a 0.5 half FTE to each part-timer. And we found this to be especially beneficial if you have some part-timers in your head count who before the pandemic were working a lot more hours and now their hours have been a little bit less. Makes it a lot easier to not lose your average head count if you count those as just a straight half. So there are a couple of full-time equivalency calculations that you're going to need when you apply for your forgiveness. You'll need your FTE head count the day that you applied for your PPP loan. That was probably back in like April or May. You'll need your FTE head count on the day that you apply for forgiveness. And you'll need your average FTE head count for your covered PPP period. If your head count when you apply for forgiveness is less than your head count when you apply for the PPP loan, you will need to do some additional head count figures to apply for some safe harbors. There are several ways that you can avoid having your forgiveness reduced due to reduced head count or reduced wages. There are 2 safe harbors that you could try to claim, which would show you operated at the same level as in previous periods. There's also an exclusion for businesses that were just not allowed to operate due to a government mandated shutdown. And there is the option to rehire or bring on equivalent new staffers to get your head count back up by December 31st. With a little creativity, most businesses should be able to work out a plan to avoid reduced forgiveness based on reduced head count or reduced wages. Let's talk about forgiveness. Please don't panic if your bank has not started taking forgiveness applications yet. So far, we've only seen banks open forgiveness applications for loans above $150,000. Most banks are waiting pending the outcome of some legislation that could streamline forgiveness for loans below $150,000. Regarding our timelines for forgiveness, you have up to 10 months after the end of your PPP covered period to submit your forgiveness application. Even if you were one of the first loans to get funded, like me on April 15th, and you went with the shortest 8-week PPP covered period, this means that I would have until April of 2021 to apply for forgiveness. I have even longer if I go with the 24-week PPP period. I would have until the end of July to apply. So we still have plenty of time to sort this out. This means we still have plenty of time to get strategic about when we put our application in. In the first place, most of us can't even apply yet. And in the second place, you'll want to look at your wages and head counts to determine when you would get the best forgiveness results and do your application then. Once your bank opens their forgiveness application period, you put in your forgiveness application. So, first step would be I apply to my bank for forgiveness. And from the time that I put my application in to my bank has 60 days to let the SBA know about their decision. And once my bank says to the SBA, yes, this loan qualifies for forgiveness, then the SBA has 90 days to send my bank money to pay off my PPP loan and interest. So that might sound like a long time. Be patient. 60 days plus 90 days means that it could possibly be 150 days total, and it might take a few months for you to get the final word. Here's an example of what my potential forgiveness timeline could look like. If I put my forgiveness application in on November 1st, then my bank has 60 days to let the SBA know. Their deadline would be December 30th. The SBA has 90 days to turn payment around, which means that my bank might get paid by March 31st. So could be April before I actually have the final answer of what's happening with my PPP loan. Speaking of the interest, I want to remind everybody that there is a 1% interest rate on these PPP loans. That 1% interest began being charged on the day that you got your loan. And we have seen some banks sending out notifications that kind of make it sound like this is something new or that business owners are going to be on the hook for that interest. This 1% interest has always been the plan, and the intention was always that the SBA was going to pay your bank for that interest. We've also seen some banks sending out notifications that payments may soon be due. But the SBA says that businesses are not required to make any payments until after the SBA sends your forgiven amount to your bank. So really this means that as long as your bank is delaying letting you put your forgiveness application in, they're also delaying starting the clock on when you're going to have to make payments. So what we've seen with the applications we've assisted our clients with this far is that each bank has their own process for applying and for backup documentation. We've seen banks refuse Excel spreadsheets and require PDF documents instead, so that might be something you run into. We've seen business owners get tripped up on the mortgage interest that they're including with their PPP expenses. So make sure that your loan statements specify the breakdown of principal and interest for your monthly payment. If your monthly loan statements don't show that information, they just show like the total monthly amount due, you're gonna have to dig up your amortization table that came with your loan. It's that super long list of like 60 or 300 payments that you're gonna make on the loan. And it shows specifically how much each of those payments is for interest and for principal. If you have bills that get auto drafted every month from your credit card or your bank account, you're gonna need to provide adequate backup showing that your business paid that expense. So in addition to that bill, you may also need to hop onto your bank or credit card website and pull up the payment confirmation, or you may need to submit your bank statements that show where that auto draft came out of your business bank account. If you pay a bill with a check, you will need to hop on your bank website and pull that canceled check image to submit along with that bill. There was also a requirement that your bills be in place before February 15th of 2020. The SBA says they won't cover any new bills you took on after February 15th. They didn't want you to run out and buy a new work truck or start up a couple more cell phones on your business plan. So you will also need to submit a bill from January or February to show that you already had those obligations in place before the February 15th cutoff. Banks are also asking for the lease for your office space to prove the amount of rent that you pay. And if your original lease is older and has the old amount that you used to pay for your rent years ago, you're also going to need to dig up that letter that tells you what your new rent amount is for the coming year. It's that letter that your landlord sends every year showing your rent increase and your common area maintenance adjustment. It says the amount that you're going to have to pay for the coming year. We're all really hopeful that the upcoming legislation simplifies the forgiveness process and that those of us with a smaller PPP loan won't have to turn in quite so much documentation. But please note that even if we do end up not having to send a boatload of backup files with our forgiveness application, we are still required to have all that backup documentation and to keep it for 6 years in case they want to come back and audit the loan. It would be really smart to gather up all these documents now while everything is fresh. Don't put yourself in the position of trying to dig up 6-year-old documents in 2027 if the auditors come knocking. And I'm going to pass you off to Fran now, who's going to talk a little bit more about how you actually will account for these PPP funds in your books.
Okay, Lorena, thank you very much. That was very informative and well written, and the slide presentations have a lot of good information in there. So we want to talk about how we're going to count these beans the government gave us. And the IRS has put out some guidance. IRS Notice 2020-32 that is pretty much telling us that the PPP dollars that were given to each business owner who qualified is not income to you, and you will not get a 1099-C from the banker on that. And that there are no real guidelines to go by in history, because this is the first time this has ever been a thing for the government. So they're kind of relying on what looks kind of the same, and to them what kind of looks the same is grant income. So when they're giving grant dollars, they're wanting you to account for this in your financial statement like grant dollars. And so what we're wanting to do with that on your books is that we're still wanting to maintain the integrity of your books for expenses. So you're still going to allocate your payroll, your rents and so forth on your P&L like you normally would. And then we're going to add a bottom line as we scroll down into our P&L to show that we got some good grant income dollars. What we're wanting to do is make sure that we still have our cost margins and all of our scenarios on our P&L reflecting properly. And one of the reasons why you don't want to move expenses off the P&L onto a balance sheet to kind of cancel out your PPP dollars is because they may have another round of PPP coming. And if you're not able to present a P&L that shows dollars you actually spent over the course of the year, you may end up getting less than you should be getting because you're moving your expenses off your P&L. So do not do that. Keep your expenses on your P&L and then use your grant dollars under other income at the very, very bottom of your P&L to show that you got some dollars back in. And what that's going to do is create a taxable income scenario for you at the end of the year. The government, the IRS says that any expense money that is given to you, they see that as a reimbursement when they give you grant income. So you're not able to use that as write-offs. You're going to have to offset it with your PPP monies, and that's going to create a scenario where you're going to show more income as your net income on the bottom line, which means you're probably going to get taxed on those dollars. And that's one way the government is going to try to recoup some of this PP money that's coming out of their coffers now. So speaking of repaying and having taxes, so the impact on your bottom line, like I said, is going to show more taxable income, but you also have to look at the EIDL grant income. So a lot of business owners did not know that the EIDL that they were getting for quick response money, which didn't come quickly. The PPP money came faster than the EIDL, but you were getting $1,000 advance per employee that you had. So you had up to $10,000 you can get. The IRS has decided and SBA has decided that that's a refinance under the PPP dollars. So the bank is only going to get, if you qualify 100% forgiveness on your PPP dollars, the bank is going to only get the forgiveness less the EIDL money that you were given. So you're going to end up owing the bank back that EIDL loan advance on the employee portion. So a lot of business owners didn't know that. They didn't really read the fine print on that. So that's going to become a problem. The banks are not going to want to collect if you only got a $1,000 EIDL. They're not going to want to collect and hold that loan open for 1%. So the bankers are making a lot of noise about it. Doing a lot of lobbying to the government. So we'll see what happens with that. But for the way it stands now, that EIDL loan advance is going to require you to repay that at the end of your forgiveness period and when you get that forgiveness from the bank, because the SBA is only going to forward forgiveness dollars less the EIDL that was already submitted to you as a separate deposit directly from the SBA. So in closing, we just wanted to say that there's still a lot of confusion in the language, a lot of and misinterpretation, a lot of people seeing it different ways, and the SBA and the government is probably going to be making changes all the way up until the 11th hour. And we are recommending to all of our clients and anyone we speak to that you get good guidance from a CPA or a tax advisor as far as the income that's going to be shown on your bottom line. You might want to get a tax advisor involved now on what's the best way to minimize those incoming taxes that are coming your way. And that's all we have on our section, Christina.
Perfect. Thank you so much. That was really great information. And now I'd like to pass the torch on this to Stephanie Tressler. Stephanie is with Clear Road Financial. And Stephanie, I understand you're going to talk to us a little bit about cash flow management.
That's right, Christina. Thanks, Fran and Lorena. Thanks for having us and putting all this information together. It's so very helpful. Yeah, I'm going to go ahead and share my screen here and get started talking about cash flow management. We're really going to be talking about cash flow management, certainly in 2020. I'm going to touch on a little bit of PPP. I'm going to touch on a little bit of what Fran and Lorena just spoke to. But this section is really going to be about cash flow management today and beyond. So how can you manage your cash flow in a day-to-day basis? How can you set yourself up for success there, but also manage it even after a crisis occurs, during and after? So the questions that we really want to answer today are, what is cash flow and how is it different from profit? Why is monitoring cash flow important? We know that it is, but what are some other ways that we can better manage and predict our cash flow as business owners? How does PPP affect your cash flow? Again, we're going to touch on some of what Fran and Lorena just mentioned. And then what are some things that you can do starting today to make a positive impact on the cash flow of your business? So that's really the most important thing, is what can you do? So we know that profit and cash are not the same thing, right? So why is that important to talk about? Well, we know profit's important. You make sales, you market, you work to keep your expenses in line, and at the end of the year, you have this number that says you made money, hopefully. And from there, you pay taxes, you maybe bonus yourself, your employees, you might reserve some profit for investment next year. But if you've run your business for any amount of time, you know that the number at the bottom of that profit and loss statement at the end of the year, does it match the amount of money that you have in your bank account? Probably not, right? It just doesn't. And that's a difficult concept to get our heads around, but we know that that's the reality. So why not? Well, we know as business owners, there are all sorts of transactions that impact cash that don't impact profit, and vice versa, right? So what are they? Well, you might have inventory. If you're a business that has products and services for sale, or if you have any amount of inventory, that's sitting on your balance sheet, right? You might pay cash for those items, but they're not impacting the P&L yet, right? Or if you have a credit card, you can put those expenses on a credit card and you've had a transaction that impacted your profit and loss and your net income, but you haven't moved cash yet at this point. You might get a loan. If you have a loan, you know, a PPP loan, right? A big influx of cash, what it can do to the business. But right now, those PPP loans are sitting on the balance sheet. They're not impacting your P&L, but yet they dramatically impacted your cash. And of course, equipment. If you're a landscaping company or you're purchasing large pieces of equipment, you might see a depreciation expense that rolls up to the P&L, and that's nice, but that's not a dramatic impact, but it's a much bigger impact on your cash in that year. So we can see that cash and profit are not the same thing. No, can you be unprofitable and still have cash? Yeah, you bet, right? Startups do it all the time. You can have a bad year, but you still did well the year before and you still got a little cash left over. Can you be profitable and run out of cash? Yeah, I mean, that's what we want to avoid. And that's why we're here to talk about this, right? So we know why cash is important for the most part, but there's some other less known reasons other than just being able to pay our bills and maintain payroll that cash is important. One of those is if you want to use leverage in your business in the form of lines of credit or business loans. We all know in business, right? We've heard, in business you have to show you don't need a loan in order to get one, and that's true, right? So having sufficient operational cash flows is going to show your lenders and your creditors that you have the operational cash flow to pay those obligations over time. And so you want to see that. You want to be able to pay your taxes. If you're a pass-through entity like a sole proprietor and LLC, the business doesn't pay the taxes, but we'd like to be able to take a distribution from the business in order to pay those taxes, and we need cash for that, right? Expansion and scale, and of course, unforeseen expenses or dramatic drops in revenue like we've seen this year with the PPP and COVID environment. Having sufficient cash flow or cash reserves can be critical to managing our business during those types of times. So managing cash flow, there's no magic bullets when it comes to making money in your business. And we all know that marketing, sales, service, product, they all have to work together to create revenue and value in your organization. But what are some things that you can do to better manage your revenues, your sales, and your expenses in a way that optimizes your cash flow? Well, one of the things that we look at for our clients when it comes to impacting cash flow is timing. And we don't think of timing or time as an asset But when it comes to impacting cash flow, we're often thinking about, okay, I've got to increase sales, or I have to reduce costs, or I have to manage my overhead or my inventory. And those things are important. But if we're talking about things that you can do today to help cash flow without adjusting any of those other items, without having to increase your sales, without having to invest more in your marketing, timing can be a critical tool. So let's see where timing can play a role. And one of the biggest ways that timing can be important is with your accounts receivable. And accounts receivable, and the way that accounts receivable turns over, is something that a lot of businesses don't realize can have a dramatic impact on the cash flow into their business. So when we are working with our advisory clients, this is one of the first areas that we look at to figure out, is there a quick win that we can get for the business for revenue and cash by shoring up their receivables turnover cycle? So for example, well, and to be clear, as business owners, we know the bills that we have to pay: payroll, utilities, rent, and we know the dates that those are due, right? They tell us, we know when we got to pay those. And we spend time creating budgets and things to help us manage our expense cycles. But we believe that spending that amount of time managing our receivable cycle and creating predictable revenues in our companies can be just as impactful as managing our expenses. So I'll give you an example. We did a client review last year where the client was certain they were going to need to increase their revenues 50% in order to hit their targets, or to increase their sales volume 50% to hit their revenue targets. But they didn't have the capacity for extra work. They were fully at capacity. And after analyzing their accounts receivable over the last 6 quarters, we realized that there were scenarios in which their clients were not even paying them in the same quarter. And so we changed their billing structure. By changing their billing structure and terms, this client was able to dramatically increase their revenue. They were getting those receivables off the balance sheet. They're getting them onto the P&L in the current period, and their cash flow goes up immediately without having to change their sales management or hire people to increase sales and incur those expenses. So a solid, predictable AR cycle can really have a huge impact on your ability to monitor and manage your cash flow and tie your revenue to your expenses. Again, it's also one of the things that banks and lenders are going to look at to see if you're eligible for credit in your company. So let me show you an example just real quickly of how this might show up for you. This is a fictitious company. This is Craig's Landscape and Design. And any QuickBooks Pro advisor has seen this company a million times in their system. And what we can see here is that Craig's Landscape and Design, if we look at the bottom right-hand number, earned $5,200 in the month of September. And what this receivable, there's an AR aging summary, which really is saying, hey, have my clients paid me? And if they haven't, how late are they? And what we can see is that, on paper, we got $5,200 in revenue. But what we can also see is he has $1,100 in invoices that are 1 to 30 days late. And that might not seem like much at the moment, but if you look at it as a percentage, this is 22% of this customer's revenue is not collected in the current period. In fact, it's a little more if you factor in those that are 30 to 60 or 60 to 90 days overdue. And if those invoices are net 30, if they're due in 30 days, we're really talking about not getting your money for 60 days. So, shoring up your invoicing terms and really understand how am I being paid and how's the money coming into my business can be critical to your cash management. And part of that means, in order to be able to look at that AR aging summary and then move it into something that's actionable, is really having a clear understanding of your sales cycle, and creating predictability within it can have a positive effect on your cash flow. So this is, without diving into the details of how these two examples that I've got here operate, what your sales cycle is how long does it take for an order to turn into cash in my hands, right? And so the top cycle, you might be a company that a customer places an order and then you purchase the goods, or you deliver the goods, or you incur time against that project, right? And then you send out an invoice and you get paid. So how long is that cycle in your business currently? Or do you buy goods in advance? Do they sit on the shelf and then you sell them to your customers? Well, how long is that cycle, right? And how far in advance are you buying those goods? And do you have an opportunity to shorten the amount of time between purchase, and cash in hand. And that's what, good financial advisors will look at those things and help you get an understanding of what you can do. So action items here is, can you invoice due on receipt? Can you require payment prior to delivery, or can you bill 50/50 upon delivery? Can you do pre-authorized recurring bank card? If you're a services company and you're providing a service and you're waiting till the end of that month to send out your invoice, and then you're giving your client 2 weeks to pay, hey, maybe we have a way that we can change that to where we bill at the beginning of the month for services to be delivered in the current month, right? That's a great way to get predictable cash in your hand, and your clients know what they're getting. If you're sending out invoices that are paper, if you're emailing PDFs, that you're expecting to get a cash in, get your accounting system set up with a Pay Now button. Square, Stripe, even inside QuickBooks, there's lots of ways that you can get your money now, and follow up on late payments. If you've got a client if we're business owners, there's relationship there, and I get it. We're all there trying to keep that client relationship strong, but really by following up on those late payments and really putting that forward, you are keeping that client relationship strong. You're saying, hey, I don't want to let this go too long where it creates a negative environment for us. Let's get this taken care of, and be ready to take that card or ACH over the phone right then. Implement automated workflows for your accounts receivable if you can. Some accounting systems and PayPal, they'll send automatic reminders for you to try and get that money in the door. And then make it easy to pay you. Whatever you do, just make it super easy for your clients to get that money to you as quickly as possible. So that's one way with accounts receivable that you can help to get cash in your door and tie that cash to your expenses. And then the other thing that I want to talk about, cash flow management is a whole school on its own, but the one thing I also want to talk about is timing your expenses with lines of credit. And we touched on this earlier, but lines of credit, let me go back to the slide. Lines of credit, why not credit cards? Why lines of credit? Why do businesses talk about lines of credit? Well, one thing is credit cards are great for perks. If you're trying to build up, you cash in for cash, you get the hotel mileage, that's great for business owners. But they're not so great when it comes to converting to cash. So a lot of times your credit card's going to have a cash advance limit, or they're going to put a hefty fee on that cash advance limit. Lines of credit are specifically designed to pull down like cash. So, they're typically, we bring this up because they're typically secured by accounts receivable. So a good way to get your line of credit is to get your receivables in order too. So these two things go hand in hand. But what can you use a line of credit for? Well, you can use it for end of year and major purchases. So this is a way to keep cash in the business while getting the deductible expense on the profit and loss statement, right? So that's a good cash management tool. You can use your lock for emergencies. We've found in COVID that locks were lifelines for many businesses during this environment if they had them, because you can't put payroll on a credit card. You can't pay yourself with a credit card. And when revenues take a nosedive, lines of credit are a type of liquid currency, and they can be super, super helpful. So it also just in general helps you build up business credit in your business, which helps you further manage your cash flow. And you can request a line increase once per year. If you're in a favorable financial environment, ask for an increase on that line of credit, and see if you can build up that good credit for yourself. So action items that you can take today, if your AR report isn't great, take the steps we talked about previously, get it in shape, work with your bookkeeper or your financial advisor to help you. Say, what can I do? What do you see here? Get a line of credit when you don't need it. 2020 may not be the year to go secure your line of credit, but maybe 2021. Develop a relationship with a great local banker who understands your business, and have a plan for your line of credit in advance. It's okay to use it in emergencies. You just want to make sure it's available when you need it, right? And then lastly, I want to talk a little bit about PPP, crisis and cash flow, and how you can better manage your cash flow in crisis. As Fran and Lorena mentioned, they've talked a little bit about how to get prepared for your PPP forgiveness, and that's a critical piece. If you received a PP loan and it's ultimately forgiven, what Fran was talking about is the forgiven debt. The IRS has said it's not going to be considered taxable income. However, any expenses paid with those PPP dollars are not tax deductible. So what many business owners don't realize, and particularly business owners that received any substantial PPP funding, is they could have hundreds of thousands of dollars of expenses that they paid with PPP funds that aren't going to be able to be deducted on their income tax return this year. So planning for that additional cash requirement is going to be critical. So, you know, as Fran mentioned, Lorena mentioned, we're telling our clients, get with your CPAs now and start getting a plan together to plan on that additional tax liability. If you've had a loss this year, your CPA can help you navigate that. But planning is the best way to manage cash. That is the most simple way to manage cash. So lastly, to wrap up, you know, the last thing that you can do is have a plan for your profit. You know, with our clients, what we say is every year we sit down and say, okay, let's do a projection. We're going to do your budget, but let's plan for profit. What are you going to do with that profit? Well, we're going to bonus our employees 25%. We're going to take 25% for taxes. We're going to invest 20%, and then we're going to take 30% and put it in operational reserves. If you know what you're going to do with your profit, it helps you manage your cash better. Establish a tax savings account. Take 25 to 30% of your earnings each month and put them in a tax savings account so you're ready to go. You can create an operational reserves account. We recommend 3 months of fixed expenses that sit in an operational reserves. You can monitor it. You can take a look and say, do we really need this in this environment? Maybe you can use those funds for better purposes, but in general, having 3 months of operational costs covered in an account and liquid is necessary to manage your cash flow. And then pay yourself and your quarterlies on time. You know, a lot of clients get behind, and that can impact immediate cash flow when they realize, you know, 2 quarters later that they forgot to pay their quarterlies. And then just, I call it PIA, just plan, execute, assess, and adjust as you go forward. Just wanted to offer this. This is a cash flow forecast that we use in our businesses and in our business, and it can be adjusted to a client. This is something that we give away for free. So if you guys are interested, feel free to reach out to me, and I'm happy to share the cash flow forecast. This just helps convert your P&L to a cash flow forecast, and we're happy to share that with you after the webinar. All right, Christine, I'm gonna stop that and hand it back over to you.
Perfect. Thank you so much. Guys, this has been really great. I want to introduce our last panelist, Amanda Morris. Amanda's with Paper Pushers, and she's here just to give us some general tips and tricks to keep in mind when we're working with our books.
So that's a lot of great information. Thank you so much to the panel. I'm Amanda Morris, and I want to talk to you today about reporting and the do's and don'ts 2020 considering COVID-19. We, the panel, realize that PPP, cash flow, financial forecasting are not your expertise. And we are available for consultation when you need direction or confirmation regarding your individual business finances. Individual business finances are as diverse as their respective industries, but we all have the same accounting do's and don'ts that are applicable to all industries. Please do reconcile your bank accounts. This seems elementary, but numbers don't lie. This will give you or your accounting professional an insight as to what your business is spending and making each month. Reconciliations are essential to building the structure of the company and allows owners to make financial decisions and adjust spending for money-making avenues. So an example of this is, can I afford to hire someone? Does my company rely too much on one vendor? Does the company need to look for new revenue streams or operations and training to profit? 44%, a significant contribution to the U.S. economic activity, comes from small businesses, salons, gyms, offices. many industries and business owners, large corporations to sole proprietorships, have adjusted their business models to meet the client's needs. Example, delivery of a product or service, stronger web presence, and safety, buying masks and sanitation equipment, allowing for distancing in your business for the safety of your clients. These service industries have had to adjust their business models to serve their customers' needs. So we've all said this, and so I'm super grateful for the panel's expertise on this subject, but pay all of your taxes to current status. Taxes paid each month are much easier to budget than tens of thousands at the end of the year, even for companies with 50 or less employees. Tax reporting is also a great insight to financial wellness of a company. And being that this webinar is being presented in October, it's also the last quarter of the year end. So there's no time like the present. Example of this is the 2019 tax reports are a great sounding board for 2020 budgets, loans, purchasing, income. 2020 reporting will compare with prior years of normal business practices. All companies are responsible for some form of taxes. Past due taxes are both financial and creative quagmires. Really, the only other thing that I want to bring up is to review and prepare for all loan agreements. Include your credit card debt, equipment payments, traditional loans, PPP, and insurances. Include any accounts payable in your monthly budget and review agreements annually to ensure proper coverage, timely payments, and avoiding penalties. So example would be in prior years, the cost of doing business looked like this to maintain or grow my company's product or service. 2020 may look totally different because of the way in which your business was able to serve its customers. The company took a loan or bought a piece of equipment or service to grow or maintain the customer base. Review whether the investment is yielding the return you expected and make adjustments. Money is a tool in which we construct and maintain our businesses. The big don't for any year, but especially this year, is don't bury your head in the sand. Be active and address any financial concerns and successes with your accountant several times a year, and more so in a time of new opportunities. When you get a financial wellness check with your accountant, it will inform you as to how your business is responding to whatever changes may have been enacted. Don't be afraid to ask for help and be of help. You know your business best and worst qualities. Reach out to professionals in the area of your business to improve upon and to be a mentor to others in those aspects you are most successful in. Don't should on yourself. It takes action to be successful. It takes action to grow, adjust. Furthermore, not acting on your intuition and expertise is should. We must all first fail before we can succeed. So I should have, or they should have, is not action. It's detrimental to your corporate image, your employees, and your vendors, and your customers. Thank you, panel, so much. Thanks for taking the time to be conscientious about your business and how to negotiate COVID-19 2020 financials. Thank you so much.
So again, I would like to thank the whole panel as well. Again, this is Christina Bell, and I would like to share with you all the contact information for our panelists. So we had debated about having a question and answer session at the end of this session. However, we also recognize that everyone's situation is so unique, and it's also personal. You know, when you're talking about financials, we don't necessarily want to share that information with a lot of people. So what my panelists very graciously decided to do is they all agreed that they would offer the opportunity to do a free complimentary consultation to anyone who watched this webinar and who wanted to reach out for some additional questions or information on their particular financial situation, their business financial situation. So Amanda, Stephanie, Lorena, Fran, thank you so much for taking the time today to educate our listeners and to share with them some of these really incredibly important aspects of dealing with these COVID situations. And again, I wanted to sign off from me again. I'm Christina Bell with Network in Action. And if you feel like you are struggling by yourself as an entrepreneur and you would like to connect with some of these phenomenal entrepreneurs that we have in our groups, reach out to me as well, and I'd love to connect you in. So thank you again for joining us, and we'll see you soon.
So I just wanted to say, and not to be the recorded part of this, Christina, you can stop the recording, but I wanted to say what amazing speakers Amanda and Stephanie are. And I really enjoyed your talk. And Stephanie was so calming, you know, like, don't be afraid of COVID 2020 and you're going to be okay. And I just got that feeling from her that we're all going to be okay. And if we put people in the right places and reach out for help, that there's nothing to worry about.
I think that's a great thing actually to add into the so thank you, Fran. Anybody else have anything to add?
Thanks for the opportunity, Christina. This was great.
Oh, my pleasure. My pleasure.
Absolutely. And congratulations to all the business owners that have made it through 2020, even if you're still struggling. You know, I am incredibly impressed by the entrepreneurs that we see every day. And if you're out there making it work, you know, hats off to you already.
That is the truth. All right. Thank you again.
Thank you.
Bye-bye. Have a good one, ladies.